Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
All right, Sonu, we just recorded with Eddy Elfenbein as a little intro to it. How cool is this conversation going to be everyone listens to here in a couple minutes?
It was fantastic because, one thing we focus on obviously is the macroeconomic picture and then stocks broadly. You may get into sectors, things like that. But Eddy is like a true to heart stock picker, right? Yeah. From back in the day almost. I mean, which is not to say he's old, but still not to knock.
He's seasoned. Well, we talked about that. I'm forgetting stuff all the time anymore. We're seasoned.
We're all
old.
We're getting older too.
Exactly.
But no, he's got a different perspective because of that. Like, instead of getting to the macroeconomy from top down, because he's building up from bottom. It's like, okay, which companies are doing well? Which companies are likely to do well in the future? That gives him a different perspective of what's happening broadly across the economy. And at the end of the day, he's an optimist, right? Stocks for the long run in a way. So that's a great perspective.
Exactly. Without further ado, you're going to love this one. Episode 84, Carson's Facts versus Feelings, talking about everything under the sun with Eddy Elfenbein, starts right now. Hi, everyone. Welcome to a very special edition of Carson's Facts versus Feelings with Ryan and Sonu. Sonu, this is episode 80. Oh, I wrote it. 84. 84. We're getting somewhere. We're getting so old we're forgetting the numbers here. We're joined by a very special friend, Eddy Elfenbein. We've been huge fans of Eddy for a long time. We're going to have a great discussion. And we're titling this one, Talking About Everything Under the Sun with Eddy Elfenbein, which is good. So, Eddy, first things first, give us your title. We like to use titles around here. And, we're just talking, you're sitting a half mile from where you were born. Tell us about that. Let's start there. Start in the beginning.
Okay,
lay down on a couch. We're going to talk about all the issues as a child growing up and figure everything out. Yeah.
Well, I'll tell you, actually, where I was born in a hospital, but now it's, and I'm not making this up, it's a Trader Joe's now. The hospital, well, it was in Georgetown, is the Columbia Hospital for Women has now been turned into a Trader Joe's. And that's not too far. I'm in Adams Morgan, in our nation's capital. So the White House is about 1 mile that way. So if we are attacked, Eddy's gone. Eddy's just
Or maybe Eddy has more protection than the rest of us.
That's true. It could be. Yes. You have to always protect the portfolio managers.
It's like they say, flying on 9/11. Like, ooh, do I want to? That's probably the safest day, period, to fly. But Eddy, the title and name of your company real fast, and we'll just get into it.
I'm just portfolio manager for Advisor Shares, Focused Equity ETF, and I guess that's it.
All around good guy. I guess we'll go there. Now, Chelsea, we can go ahead and get that image up. So I want to start with this. I know Chelsea said take a second or two. We hung out 10 years ago.
Wow.
And I think hopefully you
see. Shirt.
Do you see that? You have the exact same shirt on. So they're on the YouTube channel. We're sharing this. This was at Uncle Howard Lindson's party. And I looked, that was October of 2024, Eddy. That is 10 years ago. We got to hang out and meet in person the first time. Been a huge fan ever since. I just thought that'd be funny to show you. Look how much younger we look, Eddy. I mean, look,
I know.
I don't know. Maybe about
Ryan, I haven't seen you in a shirt in a white shirt like that for a while.
Yeah, I don't do that anymore, I guess. I don't know. But there we are on the YouTube channel if you want to see a picture of Eddy and I. All right, Eddy, we are so excited you are here. We're going to dive in the next 35 minutes, talk about everything under the sun with Eddy Elfenbein. Sonu, feel free and fire away. Eddy's on the hot seat. Let's see if we can stump him. No, we're not going to do that. We'll have fun. Take it away, Sonu.
No, look, Crossing Wall Street is Eddy's blog. It's still called Crossing Wall Street, right? Yes, and just for everyone listening, I've been a follower of that blog of Eddy's for more than a decade now. I was just telling him before we started that I was looking back at my emails, and it's like I see emails all the way back from 2013 where I've been reading this, and they're all open, right? So it's not like unread either. So no, thank you for everything you do and sharing your thoughts. It's always nice to get different people's perspective, especially portfolio managers, right? And that gets to the fact that, what we do is asset allocation. we're trying to figure out, okay, stocks, bonds, like international stocks, US stocks, mid caps, small caps. We're not really picking individual stocks, but is stock picking a dead art right now? And it is an art as opposed to a science. So I
I
just wanted
think,
to get your perspective on that.
yeah, I mean, it's I want to say it does have its moments. Obviously, the world has turned so much towards passive, and I get it. And I don't see it any way being one or the other. There's
Mhm.
something that I think is just a lot of fun about being a stock picker, about trying to find a stock that the world has overlooked. So it's always going to be around. It's not going to go away, but it has fallen pretty dramatically over the past few decades.
Why do you think that is? I mean, and I should note for everyone here, Eddie's done phenomenally well with his stock picks. So I'll just leave it at that. Right. So,
Well, I mean, the numbers are pretty clear. It's very hard to beat the market, and you can get these low cost index funds, and it's an easy way to go. And I totally get it. I think it's for certain investors. It's a great thing to do. If you're saving for retirement, just put in your IRA, buy SPY, buy any of these. It's a great way. I'm just saying for me, it's not for me, and a lot of people like that. We enjoy the real thrill of trying to beat the market, to put your wits against the wits of everybody else and seeing if you can make money doing it as well.
So Eddie, what I think's fun about it is, we all know Nvidia and Microsoft and Apple, and I want you to talk a little bit about your ETF where you have 20 stocks in there, and every year I believe you take 5 out and add 5 more. But what you do is you're looking for, like, I'm just throwing out an example, a garbage truck company that has dividends paying and earning a lot of
Exactly.
money that nobody's talking about, and it's like the
Exactly.
slow and steady. My kids, I talk to them about equities and stuff and learning. My kids are young, right? So teach them, they all want to Nvidia, Google, that's fine. We get it. But I'm like, there are companies that every week are making money, every day are making money that you've never
Mhm.
heard of. And that's sometimes the opportunity. You want to build on that?
Sure. And the best thing is, a lot of these research departments, they're cutting back on their budgets. So these companies aren't followed. There's more
Yeah.
of these or they're followed by 2 people or something. I'll give you a great example out of the ETF is Miller Industries. It's a
Okay.
tow truck company based in Chattanooga, Tennessee.
wow.
Zero followers. And it's been a tremendous winner. And we've done very, very well. I believe it's having another good day today. Earnings are going to be coming out next week. And also, what just for people who you think, oh, I wouldn't understand this, I like companies that like Miller. It's just the very basic sales, expenses, profit, debt. There's no crazy overseas operations or
How about
forex translation. Just are they selling tow trucks or are they not selling tow trucks? And
So,
they're very good. And also a lot of times call up the companies. That's what their investor relations departments are. People would never think about doing that, but
yeah,
if people love to talk about their companies and their business. So
deal
I,
flow,
I
right?
love companies like that.
yeah, my wife had a flat tire maybe 2 or 3 weeks ago, and it took hours and I can't change a flat tire. I mean, I'd probably, anyway, leave it at that. But that's why you pay. It took hours and hours and hours. So maybe we need to get, maybe she should have done Chattanooga, and maybe it would
Call
have
the
been
folks
better, I guess.
in maybe call the investor relations, and maybe that's what we
Yeah,
they
Yeah.
make it a faster response from them saying, I'm a shareholder, so
hmm
I need some service real quick here in this part of Ohio.
Yeah.
you,
So,
you know
so
who I
we've
am. I got to use that.
We've talked about your newsletter. We're fans of Crossing Wall Street. Definitely, I want you to tell me how people can sign up for that. But let's talk about your ETF for a minute here. You gave away your stock picks for years, and then the idea came, hey, these are doing really well. Why don't we just put these in an ETF and let everybody invest? I mean, I think that's how it went. You want to build on
Yeah,
the
no, I mean,
evolution of your career here.
no, you basically got it. I mean, people were asked again and again. I love your buy list. I love what you do. I love your strategy. How can I invest in the buy list? And my answer was, I don't know. You should just buy all the stocks. And so I teamed up with Advisor Shares, and luckily they're based nearby where I am. And we said, hey, maybe we have a product here. And it all came together in 2016, and it was surprisingly easy to do it. And then I had to do something I've never thought I would do before, and that was go through and find a ticker symbol. And so crossing Wall Street, what are we going to have? I've never had to look up a ticker symbol before. And since we were traded on the NYSE ARCA, that's the archipelago for those of you older folks may remember that. So CWS was open. If the Chicago White Sox want to make an offer, if they want to take that, I'm open. But we got CWS. We started trading in 2016. It was $25. Now we're in the 60s. So we've done. To be fair, the first year we trailed the market, but since then we're slightly ahead, and that includes fees. Oh, if I could also add, we're the first ETF to have a fulcrum fee.
Mm-hmm.
This is very important. So if we the fee is dependent on how well we do versus the S&P 500. So our skin is in the game. If we fall short, shareholders get a little savings. If we do better, I get a little bonus.
Just coming back to what we were talking about before, maybe I'll tell the unsexy parts of the market, because the sexy part, it's sort of bifurcated, because one part you have the sexy part of the market is like the Nvidias, Apples, Microsofts of the world, Google, AI, and all of that. And then on the other side, you have privates, right? There's so much to talk about private investment. So it's almost like bimodal in that sense, right? And then in the middle, I was looking at a portfolio, you have the middle, like you have mid caps, you have small cap stocks, you have a lot of industrials, materials. Talk about, just a little more perspective on what you're seeing and what everyone else may be missing when they're looking at, those two sexy ends of the market.
Yeah, I mean, Nvidia, Apple, they have like 60 analysts who follow them. Is there something I'm going to find that all 60 have overlooked? It's like, oh wait, didn't get it. So that's how I think about it. And I'm not afraid of big. I feel like Intuit. That's a big tech stock. Great. They have the TurboTax and the MailChimp, great company. So I'm not against it or anything, but I'll go anywhere where I can find a good bargain. If I had a sweet spot, it would probably be that 2 billion to 10 billion area. But these are, sizable organizations, they're not little companies, right. But in the eyes of Wall Street, they're usually not as well covered. And I like companies that have really consistent operating histories. So, find me a little industrial company based in Illinois that nobody knows about, no analyst has visited. Okay, then I can get down, look, and see if we see a good bargain. But I also have, Hershey. They came out with earnings today. That's certainly a big company. Stryker, wonderful stock. I have Moody's and ICE, the owner of the NYSE. So, these are some pretty sizable companies, but I'll go anywhere to find a good bargain.
Speaking of, I was thinking when you mentioned $2 billion companies, we're recording this on Friday, May 3rd. And Apple just came out with earnings yesterday. Again, no recommendation to buy Apple or anything like that. And it holds for all the stocks we mentioned.
I was going to say, yeah, no recommendations on any of the stocks we're talking about today. I know that's probably in a disclaimer somewhere, but we'll say it one more time. Yeah.
So Apple came out and they said they're issuing, dividends, a little more dividends, increasing that, but $110 billion in buying back stock. And I always think, and especially if you're on Twitter, things like that, it's always like cash on the sidelines, right? People talk about cash on the sidelines and look at the amount of money and money markets, and that's going to go into the stock market. But usually when people are buying and selling stocks, they're buying and selling from each other. But then when a corporation like Apple comes in, $110 billion, they're buying back stock. That's essentially literally cash on the sidelines. So I was curious how you think about companies. That's one way to return money to shareholders, right? Buyback. Mm-hmm. Traditionally, I think everything's a dividends, but curious if you have any perspective on that.
I worked out the numbers on this, and this is pretty fascinating. Ryan, I think that this will impress you. But $110 billion, if you work out the math, you can give $1 to 110 billion people. That's how much that is. Think about that.
Let's double check that. Yeah.
But between dividends and buybacks, I prefer dividends, but both are fine. It's returning money to shareholders. They're basically the same thing, just in different forms. I like dividends because you're saying to shareholders, well, you can buy back if you want. We're giving you the capital to do that. One of the things I don't like about share buybacks is that it can often be done at unwise prices by the company. Also, I feel too often that mass the executive compensation, so the share count gets watered down. So if it's done well and you keep that share count the same, then that's fine. But it's really when you look at the amount of outstanding executive options,
Right.
that's a very high number. And then they announce a share buyback, and it's basically being taken away. Where a dividend is real. That's shareholders have something uh, concrete in their hands, and also it's a dividend yield is one of the most basic ways to analyze stocks. It's not a bad way if just working on that, because again, it's something real, particularly if the company has the cash flow to support that. I love to see companies that not only pay dividends but increase that every year, to see those dividend aristocrats.
So I'll jump in. I mean, so again, $110 billion stock buyback. I saw yesterday Kirby Smart, the coach over at Georgia, just signed a $130 million contract, the largest contract ever for a college football coach. And hey, Georgia, hey, it's a lot of money, but I guess you could say he probably deserves it because Georgia's pretty good last I checked.
And a state employee.
Oh, that's true too. That's why it's public. But nonetheless, here. This is the math on this one. $110 billion stock buyback. They could have purchased 8,500 Kirby Smart contracts. I mean, when you think of it like that, it's like, oh my goodness gracious.
There's a room full of them.
I'll tell you. So here, I just was looking at perusing. I believe the word is perusing. Okay. Perusing X this morning, like I tend to do, Eddie. I know you do too. I saw the Rich Dad Poor Dad guy. I'm not even going to say his name because I don't think he deserves to get his name said. But the Rich Dad Poor Dad guy said there's a crash coming. Are you worried?
Interesting.
Yes. You ever heard this before from him?
I know, exactly.
Yeah. And what's your take on these perma bears that just do this for publicity? To be honest, I'm calling him out a little bit here. I don't mind doing it because he's been so wrong, and he's probably hurt more than anyone else.
Well, the thing about if you want to be a perma bear, be extreme and never give a date.
Yeah.
So when you say they're wrong, that only shows you how right they are, because when it all comes down. Yeah. And my friend Gary Alexander is a wonderful writer about the market. He used the phrase "apocaholics," and there are people who get addicted to everything, the burning the system down. And really, there's the book, I forget the author, but the investing is the triumph of the optimist, and understanding that things will work themselves out. That's a very complicated idea, that there's lots of things that can scare you geopolitically, the debt, and all these things that can terrify you. But the market is something where people come together from all over the world and they create things that people need. Are there problems? Of course there are. But this is a place where people overcome their problems and they work together. So I think the stock market and large interconnected financial markets are one of the great inventions of mankind. It's helped growth, it's helped peace, and the idea that it's all come crashing down, I just don't pay attention to it.
Yeah, that's great. Let's pull on that thread a little bit more, because going back to your ETF, and you have about 20 holdings, 20, 25, you've always had around that. And you've never said, oh, this is the time to go to cash, at least as far as I know. I don't think you've always been fully invested, right? So it seems like you've triumph of the optimist, right? Be like, yeah, you know what? We're fully invested for a long time. To talk about a little bit more about being that and never going back. I know you follow macro data, and nothing's ever given you, the rationale to say, oh, I'm going to go 10% into cash or anything like that.
I've made a virtue of my laziness, and I think other people really should do that. But, I really think if I were to follow my instincts, I don't think it probably would have hurt me. And even I would say to investors, if you're new to the market, a good sort of mind change to think about investing. Choose a date. Say, I'm going to do all my buys and sells on May 17th. Well, that really does something. That changes how you think about the market. And you're really going to drill down and be a lot more careful about your investing. So, as you said, I change 5 stocks every year. So that means I have an average holding period of 5 years.
Right.
And so people will say, well, isn't that's bad? You're locked in. I see it as very liberating, because I want to say, okay, I'm going to enter this position, and I know it's going to average of 5 years. And am I going to be comfortable holding this for 5 years, not making any changes? I don't know where NVIDIA is going to be. Hershey, I think I have a pretty good idea what they're going to be doing 5 years from now. So in many ways, I see it as liberating. It really helps you because you're focusing on what's going to be in the long term.
That's so good. It's so good. Thank you for that.
Yeah, there's a lot of marriages that don't make it 5 years.
That's right.
So, yeah, that tells you how long you're holding some things. So, Eddie, I mean, this goes quick. We're almost at about the halfway point, give or take here. So I definitely want to focus on some macro data, some of the things that are happening right now. But I want to take a minute here. And just we've promoted this last couple of weeks, but September 9th through 11th down in Orlando, Carson Group is having our Excel conference, and it is open to anyone. Eddie, you should come on down. Open to anyone, financial advisors, people in the ETF world, all the financial stuff that's going on. There's going to be a lot of fun things. Carson's putting it on with a lot of help from our partners. It's going to be awesome. We're excited about it. And again, you go to excelconference.com. That's EXCELL, Excel Conference, all one word, .com, to check it out. There's a very, very good chance Sonu and I will do this very podcast live from there. I'm not sure who the guest is yet, but I'm sure we're going to have a pretty darn big guest, and it should be really cool. One more thing, Eddie. As I'm getting a little older, just an example, Sonu, I didn't tell you this, but listen to this. Yesterday, Sonu and I hung out in Chicago for a day. We were working on some things, doing some stuff, and I long story short, I forgot something in my room. I never should have forgot it. I was like, oh my goodness, I really, really need that. We're at the lunch. I call. They're looking for it. I still go back to the hotel just to see.
One of the few times I've seen Ryan a little tense.
Yeah, I couldn't even eat lunch. I was like, oh, I can't believe I forgot this. I mean, for me, I eat lunch.
Serious.
No, it's dead serious. So fortunately, I go back to the hotel. The security guy went in the room and found what I needed, gave it to me. That's great. Sonu, I didn't tell you this. So then yesterday, literally it's the same day. I take an Uber home from the airport, and I get home about an hour later. I'm like, where's my wallet? I left my wallet in the Uber. So I lost one thing I needed in my hotel room, and I lost my wallet the same day. So, Eddie, just be careful who you're talking to right now on this podcast. I mean, I don't know. I've never had a day like that. I don't know what it means. I think I ate too much food in Chicago is what it means. Sonu filled me up too much. But I don't know. Eddie, you're geting older. I'm getting older. Any old stories that you forget stuff? I mean, what's going on in your life?
I want to jump in and say something, and I do mean this. I'm a huge fan of what you do. And I love how you are able to come up with these sort of factoid nugget about the market. And I hope you've seen, I've referred to you
quote me all the time, so thank
times in the newsletter. And I hope you've, and I've used, and by used, I mean stolen your facts, but I do credit you. So I hope you've seen it, how often I've referred to you in the newsletter. So, and it's always a fact that, sort of reorients or orients people's thinking about the market. So I just want to say thank you for all of that over the years.
No, I saw you quoted me just a few weeks ago, I think. So on top of other times. So no, thank you for that. Sonu, so that's about the halfway point. Let's talk macro.
Yeah.
Sonu, you want to talk about
one question related to, I mean, I guess it gets to investing anyway, generally. And this is a question we haven't been able to ask other guests because they're not stock pickers, but I'm going to ask you that because I think you'll have a different perspective. Leave yourself outside of this, right? So excluding yourself, who do you think is the greatest stock picker of all time?
Ooh.
Oh boy, that's a very good question. I have a soft spot in my heart for Jesse Livermore. And I don't think anyone has really understood the markets the way he did. Tragic ending.
Yes.
It had but nobody, I don't think really got that close to understanding the market gods as he. Maybe he flew too close to the sun. Obviously, a big fan of Peter Lynch. I think what he did was amazing. So I would say, and I mean, you have to put in Warren Buffett and others, but for me, at the top, I would put Jesse Livermore.
And this is from, just for folks listening, there's a great book about that, Reminiscence of a Stock
Operator.
I think I have it somewhere, but and there's a story back in the 1920s and 30s, right?
Yeah.
So what's neat about it, though, it's all about psychology, and literally, even though it's 100 years old, it's still happening now. One more thing, and then we're going to talk macro, I swear. Carson is a $35 billion RIA with serving more than 50,000 families in the United States, based in Omaha. There's another guy based in Omaha, and then this weekend, Warren Buffett's annual event is in Omaha. I mean, again, we're doing this before that event, but just I know you know a ton about Warren Buffett. One or two Warren Buffett, things you've learned from Warren Buffett over the years that maybe other people don't know as much, Eddy?
It's a good question. I would say he's a remarkably intelligent man, and one of the things that Buffett does very well is he's able to simplify things. He can take complicated things and make it simple. And I don't think people get the because it's so simple. He makes something so simple. I don't think people realize the complexity behind that. And one of the problems about Wall Street that I complain about is they make simple things more complex. Just even, somebody will say, net capital allocation, more money. Everything's got to be muddied. Everything's got to be, placed more difficult than it needs to be. So that's one of the things I really admire about. Oh, and by the way, he is from. I know you say he's from in Omaha, but where did he spend a large part of his life? Right here in Northwest Washington, D.C.
Oh,
Wow.
His father was a member of Congress.
Yes, I think I knew that. Yes, but no, that's great. It's
He's
always,
a product of D.C. public schools.
there you go. Let's just leave it at that.
So I'll jump in then. So Sonu and Eddy, love your take. Jobs number just came out this morning, right? I mean, Sonu, maybe you can go first. I know you've dug in a little bit. You're writing a blog, and Eddy, love your take too. But it came in a little weaker than expected. The only thing I'm going to add to this, our friends at Bespoke looked at the last 24 months of jobs, so last 2 years. 21 times the job number came in better than expected, about a 79,000 average beat. And Bespoke said that's never happened in history, to see that many jobs beat that consistently by that much. Sonu, is this the start of kind of weakening jobs? But 179, that's still pretty good, right?
175,000
or 175. My bad.
Here's some perspective, right? Before the pandemic, 2019, monthly job creation averaged 166,000, and we thought that was a strong economy. 175,000 is above that, right? Mm-hmm. But these things get revised. All of us know that. So you take a 3-month average. Last 3 months, you've averaged about 242,000 jobs, right? The unemployment rate is at 3.9%. Yes, it went up slightly, but it's been below 4% for 27 straight months. You and I have talked about this before. I like to look at the employment population ratio simply because with unemployment, one part of the issue is you have to define, okay, who's unemployed. And then technically, it's only people who are actively looking for a job. Now, if you stop looking for a job for 2 weeks, they don't count you as unemployed, right? For any number of reasons. So because of that, it's almost easier measuring, okay, how many people are employed as a percentage of the population? That's the employment population ratio. But then we have demographic issues. Like, it's not an issue. It's just what it is, right? People are leaving the workforce. A lot of baby boomers are retiring every day after day. So to get around that, look at the prime age employment population ratio between 25 and 54 years. That ticked up to 80.8%. That's the highest we've seen. We haven't seen the highest we got to between 2001 and 2019 was 80.4%. Right? That by in and of itself tells you how strong this labor market is. And I think we joke like that measure tells you that everyone wants to work now. And look, at the end of the day, nominal, if you look at aggregate income growth, like you think about the economy, and that's where profits come from, right? Nominal GDP growth is probably growing around between 5 and 6%. Is that harder than before the pandemic? Yes. Is it too hard? I don't think so, because 2 years ago, nominal GDP growth was running around 10% when we had a lot of inflationary problems. So, and where does nominal GDP growth come from? Consumption. Where does consumption come from? Income growth, right? Aggregate income growth, which combines employment growth, hours worked, change in hours worked, and payroll growth, wages. That's growing around 5.5%, 6% right now. So that's strong. That's good. It's not red hot.
I'll just jump in. I think you just made the rich dad, poor dad guy just like slam his computer down after hearing what you just said. Eddy, jobs number, maybe a time to look into it, or maybe if you also want to talk about the Fed a little bit. Eddy, just this week, macro, lots happened. What's your take, and what's something you found?
Sure. I mean, 175 below expectations, but not a terrible number. What probably the most concerning to me was the average hourly earnings was pretty weak. I think that was 0.2, which was 0.1 below expectations. And over the past year, I want to say 3.9 or 4%, right in that area. Not a whole lot more ahead of inflation. I'd like to see a little better numbers in that area. I said, I think it's 27 months in a row below 4%. We forget, I'll give you here's a good stat, is at 3.9, we're that's lower than we were every single month in the 1970s, the 1980s, the 1990s, the 2000s, and the teens through 2017, except for 1 month. So it would be second in that 47-year stretch. And people are saying, people complaining about the economy and how bad it is, and that's the highest the unemployment rate has been in some time. I wanted to add a point to what you mentioned before about looking at the different measurements of employment versus the overall economy. Now, one of the reasons why the labor force participation rate, people make way too much about that. It's strongly influenced by demographics and the older population. So we see, that's what is a drag on that. So looking at that the prime working age people, those 25 to 54, and I believe, as you said, we're very close to a 25-year high. I haven't looked at the days, but we're up there.
Yeah.
And a few people would believe that we are.
I mean, it's doom and gloom all around us, but
exactly. But there's a point I want to make about that is that when people say, "Oh, there are baby boomers, so there's a reason why people aren't working," remember the macro economy doesn't care about that. It only cares about the number of people to the number of people who aren't working. So even if there are all these, retirees, that's great. They have an excuse not to work, but it doesn't matter. There's still people who every day have to place to sleep, something to eat, and they're not working. So we only care about that ratio of workers to non-workers. That's just a point I want to make that's often overlooked. And it's how people of a more economic bent think about the economy versus that's sort of at the level of the news we see. The financial news.
Well, that was great. This again is episode 84 of Carson's Facts versus Feelings. Talk about everything under the sun with Eddy Elfenbein. Eddy, the Fed also was this week. I mean, did you? I guess my take is we've seen yields drop pretty significantly since, at least 2-year yields dropped since then. So was the Fed really that dovish, or were they just not as hawkish as feared? Where do you lie with the Fed?
I think it's the latter. They weren't as hawkish as fears. And I mean, look, you get right down to it with the economy where it is right now, commodity prices, the market, at least through March. I just don't see the need to jump in with a rate cut to help us out. I mean, maybe some fine tuning, but I just don't see the need. In fact, I would even go further as I don't see the need why we have to be wedded to a 2% inflation target. If nominal GDP is going to be stuck at 6%, which it appears it may be for the last 2 years, what's wrong with a 2.8 or a 3.1 inflation rate? We got it down from 9 to 3 pretty easily. And it looks like getting it from 3 to 2 is going to be a lot more difficult than people expect. From what I've seen now, it looks, this is an early read, that the futures markets have brought forward the timing of a rate cut. I think even July is about 48%. That's July 31st meeting. And that's up about 10% from yesterday. I think those numbers are correct. I haven't seen it. It takes a while for the market to digest everything. It's very possible we'll get a rate cut, before baseball season is over.
Sonu, I just realized you're like out of the country July 31st. They can't cut then. I need you. We need you here.
You need to do my notes for me for our advisors. But
yeah, Sonu, what do you think about the Fed? You dug in. What did you find there?
I think too they were less hawkish than expected. I think that's it. Or are they dovish? No, rates are 5.5%. They're not dovish by any means, right? And they're intending to keep it there. So let's call a spade, right? That's not dovish. They think they're restrictive. I think it's fairly restrictive. Is there a need to cut? I mean, like I think we've both been in Eddy's camp. Like maybe some fine tuning. At the beginning of the year, we expected maybe 2 cuts, 3 cuts or so. The market was like schizophrenic, right? Almost like 7 rate cuts. No, I mean, nominal GDP to what Eddy was just speaking to, growing at 6%, you're not going to get 7 rate cuts like that. That's down 1.5 percentage points, right? No, that clearly is not happening unless something happened, the labor market broke, but that's not happening either.
And remember, a year ago, if you ask people like, oh, sure, the Fed will be cutting rates by May of 2024. Absolutely. No doubt. All that's out the window.
Yeah.
Yeah.
Broader question on the top related to the Fed. What's your perspective on interest rates and how it relates to the market? Because, and very broadly, rates are at zero over the last decade. After 2018, it had 2%, 2.5%. Markets went up a lot, right? Now you can argue which parts of the market, but set that aside. Broadly speaking, the S&P 500 went up. Last year, rates are at 5.5% policy rates. Market went up with 26%. So when you look at it like, do interest rates even matter here? And I know, especially from your perspective, you're looking at companies and they have to borrow money to invest in things like that. So just curious about your take.
Yeah, I mean, long-term interest rates, that's the most important factor that impacts the stock market. And there's two major reasons. One is obviously their financing or even potential financing that people want to do mergers and acquisitions. That's where you're going to go to the bond market to fund that. So you're always looking at the eternal battle between long-term interest rates and the stock market. And then the other reason is it's the competition, so that's where valuations are going to be. So as long as as rates go lower, those valuations can go higher. As rates go higher, the valuations can drop. So it's always going to be following that, and interest rates are just sort of wedded so closely to where the stock market is going. Also, we can see within the markets where you see the battle between cyclical stocks, defensive stocks are going to be very much tied to that cycle within the market. So even you'll get cyclical stocks that will outperform usually during a bullish market. So you'll get that double whammy effect. I like a lot of those defensive companies, like we talked about Hershey, that they're going to tend to lead the market when the economy gets weaker. So it's important that investors sort of understand not the overall of what their businesses do and how they're impacted by larger macro themes.
That's great. Thank you for that.
Yeah, sad story here. I just threw away a bunch of our Easter candy last week. Like, it was just out. And I said, you know what? I'm getting rid of it. I'm getting rid of it. Speaking of Hershey chocolate.
It's a sad story.
Yeah,
Were the kids unhappy? Were they upset?
They didn't even know. They didn't know. I just said, you know what? It just is sitting there. So, okay, it's time to probably get rid of this. So again, this particular podcast everyone's listening to will come out on, let me make sure I've got the date right, Wednesday, May 8th. Just so people know, on Wednesday, May 9th, Sonu and I will be live from Omaha at Carson's Partners Summit, where we're going to invite all of our almost approximately 500 partners to come to town. I know we've got a lot coming, and it's going to be a lot of fun. We're doing a live stream, Facts versus Feelings, with Burt White. We mentioned last week Burt was just named CEO a couple of weeks ago, and it'll be a lot of fun to talk with Burt on a live stream. The easiest way to know where that's coming, just follow Sonu and I on X or LinkedIn. We'll be sharing when. I mean, we know where. It's in Omaha. When, I'm not 100% sure. Sometime that Thursday afternoon, if you're listening to this podcast on Wednesday morning or Wednesday evening, Thursday morning, check out the live stream with Burt. But if you miss it, that's okay, because we will actually the following week have that as our Facts versus Feelings weekly podcast to discuss Burt White. Or talk with Burt about the future of Carson in general. But we've got Burt on the show. We're going to talk macro with Burt as well.
He was a CIO as well. So.
He was a CIO for a long time at a couple very big shops. So we're gonna pick his brain there. All right, Eddie, we have about 5 minutes. It's amazing how fast things go when you're having fun. I always do like to ask this one: any mentors over the years, and what have you learned from them?
I just mentioned Gary Alexander, somebody that I worked with years ago, and somebody who just knew has a great breadth of market knowledge, particularly market history. So that got me to sort of read about things, and you realize that a lot of these things, they happen again and again. They have different names and different particulars, but a lot of the same things happen again and again. So I learned a lot from Gary, great person within the financial world.
That's great. Bring it back to, I know we're close to time here, so a broader question. And you mentioned interest rates, and it's like bonds being the competition to stocks. Now, clearly, bond interest rates have gone up. People are getting maybe 5.5% in their CDs. What's, in your view, make the case for stocks?
It's interesting you say that, and it's a very good question, because if a person looks at the market right now and they say, I don't want to deal with the market, I don't want to deal with Biden and Trump and whatever the hell is going to happen over the next 5 years,
Mm-hmm.
I'm going to sit all in a treasury and make a pretty, you know exactly what you're going to make.
Yeah.
It's 100%, there's as little risk as possible. I totally get that. I totally understand that. It's not for me, but I understand that. I think the best way is always to go with stock. Now, this is an important point: is that stocks and bonds are not the same thing. Bonds are an asset. Stocks are equity. Equity can buy assets. Assets can't buy stocks. So a bond only exists as long as it's a bond. Once you get your money back, then the bond ends. Stocks don't have to do that. Stocks are, it's equity that's people coming together, employing assets to make a profit that can grow higher and higher and higher. Bonds, while they have that risk protection, it has that guaranteed or near guaranteed, stocks can't do that. But in my opinion, you're giving up a lot for that perceived safety.
I love that. I've never thought about it in that perspective before. Like, bonds are assets, but assets can't buy equity, but equity can buy assets.
I can start my own company and go out and buy bonds.
Right.
And I can borrow more money and buy more bonds. And this bond buying company, which you may want to call a bank, you don't have to.
Sure.
That's what you can do. But bonds can't do the reverse.
Mm-hmm.
That's interesting. I mean, Eddy, so again, we're huge fans. Congratulations on all the success with the Crossing Wall Street newsletter, and then I guess the ETF
and the ETF
called Crossing Wall Street ETF. What is the name of the ETF?
The official, so the ticker symbol is CWS.
CWS is the ticker,
but the official name is the Advisor Shares Focused Equity ETF.
Ooh. I would not have guessed that. Okay, I just call Eddy. It's just Eddy's ETF.
Managed by Eddy Elfenbein.
Yeah, that's the part that matters. So we do have a lot of financial advisors that obviously listen to this particular podcast. I mean, you've been in the industry a while. You've probably worked with financial advisors. What's one bit of advice you can give a financial advisor, whether it be about the industry, about working with clients, working with ETFs, just wherever you want to take this, but something you've learned that you think is valuable for a financial advisor listening to take away to help their practice?
I guess, good question. Don't be locked in to the, I think, small universe that tends to dominate a lot of thinking on Wall Street. It's okay to get off-road a little bit. In fact, if you have a secure portfolio that even is tailor-made, then you have that latitude to go in different areas. I'm not talking about high risk. I'm just talking about there are so many smart people. There's so many good investments out there. Don't lock yourself into that very small universe of investing.
Love it. So, anything final from you before I bring us home?
No, I think this is fantastic, Eddy. Thank you so much for coming on. Like I said, for everyone listening, I've been a massive follower of Eddy's for a long time. I don't really usually my usual choice of newsletters or things like that are related to macro and what happens on that side. It's not often I'm reading a newsletter written by somebody who picks stocks, but that's what Eddy does, and he's got great macro perspective as well because of how he looks at the world from that bottom up perspective. So I definitely recommend his Substack as well. I think it's Substack, right? So definitely go read that. I think you'll enjoy even reading past issues of that, to be honest. Right. I went back just last night. I was reading a few of your back posts, and those are, again, like I said, great perspective. Thank you for everything you do. Thank you for sharing as well.
Thank you. And also, I ran the numbers on this. Ryan, you would be impressed by that.
Okay. But I'm not easily impressed. Let's hear it.
Listen, every time I've been a guest on this podcast, if you look at the next 6, 12, and 18 months, the market has never been down. Not once.
There you go.
But just consider that.
There we go. We can't make guarantees in this world, but we are pointing out the facts. Exactly.
These are the facts. I'm just passing on facts.
I mean, this is facts versus feelings. I mean, this is facts versus feelings. So again, this was episode 84 of Carson's Facts versus Feelings. Talking about everything under the sun with Eddy Elfenbein. Eddy, thank you so much. Help us out by telling us how we're doing leave a review, use the thumb buttons, and subscribe if you want to hear the latest. Thank you, Chelsea, our producer there. And thank you to Eddy for joining us. Thanks, Sonu, as always, for a fun conversation. This is episode 84. I think it's one of the best ones. Hopefully you guys enjoyed it. We'll be back next week. It'll be, again, a replay from our discussion with Bert White, our new CEO. Although Bert's been at Carson for over 2 years now, but Bert was promoted to CEO. It'll be an awesome discussion on the future of our industry, how the future of Carson, and how we're going to continue to change the world and to make things better for financial advisors and their clients. In the meantime, listen to Eddy. Check out Eddy. We'll see everybody next week. Take care. Goodbye.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.